expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. 2024. This is The Mortgage Voice. I'm Jeff Barton, and welcome to the show. Thanks very much for tuning in. This week, as well as every week we've been doing for the last 10 years, we bring to you mortgage information that you're going to need to get out there and hard charge into the 24 real estate market. Now, we're going to go through a little bit of what happened, some of what is, and some looking towards the future. Everybody wants to have an opportunity to buy a house. Those people who've been waiting around, waiting for either prices to drop or waiting for the mortgage interest rates to drop, or both. There may be some, maybe a little, but it's not the greatest news. It's a continuation, really, of 2023. Anyway, we'll get to all of that. I am Jeff Barton. This is The Mortgage Voice. Thanks very much for tuning in. If you want to see the show, now, if you want to see the show, you can see my tie, which I put on today as part of the New Year's resolution to dress me up a little bit. Not the show. The show's always got a great look. But me personally, yes, dress me up, take me out, set me in front of somebody, and I can appear like I know what I'm talking about. Anyway, go to YouTube, Jeff Barton, The Mortgage Voice, and you can see me there in this great tie. Pink shirt, blue tie. And you can see that if you go to Jeff Barton, The Mortgage Voice on YouTube. Okay, so let's get right to it. This is first week of January in the new year. I don't know why people get fired up about things in the new year, but I think there's a need for everybody to have this renewal in their head, that they can start over again. As I often tell my children and anybody who is going through it, whatever that it is, and everybody out there knows what that is, whether it's an economic issue, a family health emergency, something that you're going through, that it part of what you're going through is difficult, and it remains difficult. And the problem with all difficulties is that they eventually stop. But in the interim, as they often used to say back in the day in the rooms, yes, one door closes, a window open, but it's heck in the hall, right? It's tough out there when you're in that space. And so if you're in that space, I get it. I know where you're coming from. We're going to try to provide some information to get you down the road, closer to that house you want, closer to that mortgage rate you want. And if nothing else, you can become educated. And education in this particular business is the best thing. Do not rely upon somebody else to tell you how things are, especially when it comes to the biggest purchase of your life. And most people, a house purchase or a mortgage is exactly that. So when you're out there and you're looking around, make sure you're tuned in. KCAA is our radio station out there in the IE. Been with them for a long, long time. Fred and Mark and all the guys out there and gals, really appreciate the effort that they put in to not only bringing us to the airwaves in the IE, San Bernardino and Riverside counties, but also they have a great archive of our shows, podcasting, couple different stations, AM and FM. And we're on Saturday and Sunday on the weekends, which is typical for this kind of show. As we're not prime time, but we certainly are in need, especially on time when you need that information. So there you go, and that's the way I see it. Malibu Funding, which has sponsored this show forever, continues to do so, was sold last year, sold to a new owner, Chris Pyro of Searchlight Lending. So that part of my particular business career is in the rearview mirror, which is a good thing. It allows me to concentrate way more on the show and to be able to bring good information to you, really timely information to you without the stress that I always have. Now, anybody in business will tell you, it is a stressful time. You know when it wasn't a stressful time for the mortgage industry? During COVID. Because interest rates were 3%, and if you couldn't make money during that time, then you can't make money anytime. But the last year and a half, 2 years have been tough. They've been tough because rates went all the way up to 8.5%. Last year, about August, maybe a little bit in July, August, September. Then they started to fall, and we are now at about 6.75% on a 30-year fixed. The 15-year, and I love that 15-year product, by the way. So if you're thinking about getting a loan and you can make a higher payment on a monthly basis, the 6.04 interest rate on a 15-year is really nice. I told you, and I think I've told this audience many, many times, the last interest rate I had on a loan for my house, which was, 10, 12 years ago, was 5.125%. So at this 6.04%, it's not that far off, 3/4 of a point or such, towards the best interest rate I had. Now, obviously, interest rates went lower than my 5.125, but I was comfortable with the 15-year rate that I got and the payment that I had to make on a monthly. And so if you're looking at a way to get into a market with a cheaper rate and to get your equity built more quickly, i.e. if you pay it off in 15 years, anything after that is gravy. So that is a way to go. If you're looking at FHA, 6.18, another great loan. You're adding in the mortgage insurance premium on top of that, of course. Everybody knows that. But at the same time, 6.18 is a pretty good deal. There are down payment assistance programs, especially in January. A lot of the county-wide DPA programs have a certain amount of funds budgeted on the annual. And each annual budget, that money that is set aside for down payment assistance programs in that county or in that city even, they will expire when the money runs out. But January is a great time to get your application in and see what monies are available to you so that you can use that towards either your closing costs, your down payment, whatever it is you need. The jumbo rate is still higher than most, but a lot less than it was. I mean, it was well over 8.5%. It's now about 7% nationally on an average. That's pretty good for jumbo money. If you're out there right now and you're thinking, look, I need a loan at X amount, especially conforming jumbo, obviously anything. I think the conforming rates went up last year countywide in San Bernardino and Riverside counties, and I would check with the local broker, whoever. You can go online, and they, I think, are 768, but you'll have to check, 768,000. Prices haven't come down in real estate, and that's usually they look at the median real estate price or the average real estate price. I forget what it is, and they raise or lower the amount that the countywide conforming limits are. And so today, that's what I believe they are out there. 6.23 is the 5/1 ARM. It's still a good product. Anything in the sixes, I think it could be a solid year. Obviously, if rates lower, that'd be even better, but that's where we are in terms of rates across the board. 6.76% for the 30-year, 6.04 for the 15, 6.18 for the FHA, 7% for jumbo, and 6.23% for the 5/1 ARM. The 2-year is trading at 4.38%, and the 10-year is 3.99. That's a spread of about 60 basis points. We've seen it come down as much as to 39, 40 basis points. We see the narrowing of this spread. Now, this 2-year over 10-year in terms of the yields has been this way for 2 years. Now, this used to be a way by which, and 100% of the time it happened, you could predict recessions. Well, now that we're dancing with the no recession, soft landing scenario, it looks like what we have in this spread is an anomaly. We'll have to obviously wait it out. And some of these recessions come 2 years later. There may be other factors. For instance, there could be world events, could be weather events, there could be all kinds of things that affect the money. Talked to a friend of mine, just a quick story about how things change and what they change. I saw online today that in 1970, compared to the dollar there, compared to the dollar today, you've lost 87% of your buying power since then. But my friend, I'll get to this on the other side of the break, but he was just talking about very similar stuff. If you're printing money and the inflation rate goes up and then you're giving people less money to purchase things based on printing money, and then you tax that based on the new tax rate. It was an argument that I've heard many, many, many times, and do not disagree with it. There is a fundamental flaw in that kind of thinking. I think it's short-term, and I also think that it drives headlines, but it doesn't necessarily do anything for the next generation that's got to come along and clean up the mess. I'm not going to be around to do it, that's for sure. But it could come to fruition, for my kids, and that's why somebody's got to deal with the issue of printing money, inflation, and the rest. I'm Jeff Barton, your voice in the mortgage industry. Thanks for listening in. Welcome to 2024, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us, coming to us for the information that we give to you each and every week about mortgages, about home prices, about real estate, about all things that you need to consider when you're going to make the big leap and buy a home, buy your first home, maybe sell a home and move into something more affordable or with less space because you just don't need it anymore. Maybe you need a single-story home and you've been in a two-story home, and that's what you're looking for. The question of how many people are going to do that is really at the heart of why we have prices the way they are. We have a lot of frozen, locked-in people because the rates are so low. Now, if you are of my age, now I'm almost 70 years old, but if you're around my age, let's say you're retired or retiring soon, and you're looking at your house as, a tremendous amount of equity in it, you refi during the great refi boom, and your mortgage interest rate is about 3.5%, 4%, 3%, in that range, right? You're looking at the interest rates now, and I quoted, 6.5%, 6.75% for the 30-year fix, and you're saying to yourself, well, do I really want to sell my house now, even though I don't need all this room, to get into a 6 or 7% mortgage interest rate when I'm currently now in a 3% rate, or I've paid my house off? Do I really want to do that? That's called lock-in. Now, that's not just for retired people. Anybody who has bought a house in the last 5 years, every one of these people are into a rate, unless you bought it last year, that's pretty low. And it's probably as low as it's ever going to be. And your interest payments are awesome. But if you need to sell your house, if you want to sell your house, if you want to step up in the size of the house, if you want to, do all these different things that people do in normal situations, you are reluctant to do so because of the interest rate that you currently have. Your mortgage interest payment is so low that it's hard to justify going out there and spending more money either for product or for interest rate on your mortgage. It just is. That's why the amount of housing on the market is so low. It's historically low, even though we did see some improvement. But if you're looking for a wholesale improvement, there's only a few things you can do in order to get that. You either have to sell houses that currently exist, build more houses that don't exist, or what? Exactly. Kick people out of their house so that you can buy it. None of those scenarios are going to happen in 2024. We may see an uptick in house building, and I think that that's a reasonable thing to expect. But we need 1.5 million houses like today. Well, that's not going to happen this year. The permitting process, the not in my backyard crew that's out there protesting anything that gets in the way. In my town, it's about lights. They have a light ordinance, so you can't build a house with outdoor lighting anywhere. It has to be dark. And so there are a lot of groups out there that will protest anything that you've got going on because you want to do it. And so it makes building more costly, all these kind of things that go on. Okay, so one of the things that was a bit of a phenomenon end of last year and predicted to go into 2024 is the amount of people who are backing out of contracts once they get into contract on buying a home. There's a lot of reasons for that, right? So let's get into a couple of those, just so if you're in this position and you're feeling guilty because you're not buying, or you're anxious because you want to get out of the deal but you don't want to lose out on this particular property, you're not alone, and you're among a lot of people who have the same feeling about home buying in this particular market. Okay, so wrote down a list of several things in here, and I will give you some statistics as to what this backing out of your home sales contract, what it is and what's it like, and how is it today worse than it's ever been. Home buying, backing out of deals, highest rate on record. That's today. 45,000 people in November of 2023 backed out of their contract. That's a lot of people. 45,000 in 1 month? Well, you can extrapolate that over a year, and you maybe have close to 3.5, 400,000 people who backed out of their contract for whatever reason, which is well above what it normally is. And there's a reason for all that, right? 16.8% of the people who were in contract backed out in October. So you can see this is a trend that's continuing. Why? The mortgage interest rates. You get into a deal, you've already stretched yourself as far and as wide as you could possibly do it, and the seller wants a little bit more. So you give in just to get into contract because you really want that house. Then you get, of course, everybody knows, buyer's remorse. And that buyer's remorse is backed up because there are a lot of costs associated with buying a home. Mortgage rates, they're fluctuating. You may get into contract at one number. A week later, when it comes to locking in, or 2 weeks, whenever it is that you can lock, it turns out that the rates went up and you really can't afford it or don't want to afford it because, let's face it, 70% of your income towards your mortgage payment is probably not a good thing. The home price, right. You got into contract, you paid more than you wanted to, now you're sitting soberly looking at the numbers and saying, hey, this cannot work, will not work, and I don't want to work 12 hours a day just to pay for it. So that's another one. A lot of people don't realize, well, maybe you do, because if you've paid attention, you're in the home buying world. Insurance, homeowners insurance has gone through the roof. There are some states that had to rewrite legislation in order to augment some of the insurance that was pulling out of states. Florida is one of these states. California is another state. If you're in a high fire zone, a flood zone, or an earthquake zone, which I think is the entire state, a lot of people are, leaving the marketplace. What are we doing? What are they doing? Well, that's another reason why people do not want to continue with their home buying. They just can't afford it because the insurance rates are not fixed. The renovation costs. Oh, yeah, this is a big one. Most people look for the worst house in the best neighborhood. The reason for that is obvious. Price, cost. It's going to cost you to buy that house a lot less than walk-in ready, beautiful house, right? So that's what they look for. Now, you get into contract, you got exactly what you wanted in terms of the worst house in the best neighborhood. Then you start to itemize what the costs are for things that you need to renovate in order to make it absolutely your home, absolutely the thing you want. And you figure out, hey, this is going to cost me way more than I want to. I'll get into this in a little bit. The last one here is cost to maintain. Nobody really looks at this. They will look at what the bank needs in terms of what you have to make to afford the mortgage payment. That's what they look at. They don't look at what you have to do to maintain your home. Now, my particular home, let's just talk about this. For years, I've been going to work every day, making a living, bringing the money home. And my spouse, who works at home, had been in charge of the family budget. And for years, I wasn't really paying that much attention. Since I have now more time on my hands, I've tried to get in there and help. And looking at the costs of things and what they cost to upkeep is unbelievable. I didn't know you could vacuum the pipes to your dryer. They call it, what do they call it? Do you know what they call it, Daryl?
Delinting.
Yeah, something like that, exactly, because it's a fire hazard. I'm like, well, who is this guy? Why are we paying? It was unbelievable. I think it was $600 a year for this guy.
It's a chimney sweep for your
Yeah,
dryer.
something exactly like that. And I'm like, I didn't even think that this was an issue. Now, we have a swimming pool, right? There's the pool person. Okay, so you start to add up, and I'm not out there gardening, so we got somebody that comes once a week and does that kind of work. So all these little things, the maintenance of the house itself, the upkeep, the painting, the termites, it really adds up, and it causes people to give I don't think I'm going to do this approach towards buying a home. I want to get to some other things, the 5 costly home renovations, the 5 most costly home renovations that you need to skip in 2024. We'll get to it in the last segment. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week as we bring to you updated mortgage information as well as some opinions, a lot of opinions. You know, most of the stuff that I talk about are opinions, my opinions after, 30, 40 years in the business, making sure that you get informed and entertained, and that's part of what we try to do. As I was telling people earlier in the segment, there's all kinds of reasons to buy, there's all kinds of reasons not to buy, and we've seen some things happening in markets across the country which are confusing, right? If people are backing out of contracts for real estate, yet at the same time we don't have enough housing, how is this offsetting, and why do these conflicting stories always confuse buyers? Well, that's why we're here. That's why we're trying to bring to you full and accurate news so that you get some clarity. Obviously, mortgage interest rates seem to be settled into the 6 to 7% range, but I'm not the expert on that. Joining us once again is the in-house expert, is Charles Giscombe from United Security Financial. He joins us now from parts unknown. Where are you, Charles? How are you? Welcome to the show.
Hey, Jeff, thanks for having me.
Sure.
I'm in Charlotte, North Carolina today.
Oh, okay.
Good to be here, and Happy New Year.
Happy New Year to you. Okay, so we have winter weather here finally in Southern California. How is it there, and how is it affecting people? Are they out and about? How was the holiday season? Did you see much action in the mortgage world? What's going on?
Well, Jeff, just like I am on the show, like Jeff says, Charles does loans all over the country. It seemed like I was all over the country for the holiday and right before the holiday. And so what I will say is the weather is good in Charlotte. I was in Vegas before there and then flew across the country to Florida on Christmas Eve to be with my family.
Oh.
Just like everywhere else, people are still transacting. The weather is good in all the places that I was at. Thank God.
Nice, nice, yeah.
But I'm seeing a lot of bubbling and excitement with individuals who are seeing the interest rates come down. I'm starting to get a lot more phone calls because, people are asking me as though I am Nostradamus and I can foresee the interest rate future. But as we see it right now, we're probably at an average of about 6.93%. That's where we're at right now. I think that's great considering, 2 months ago, Jeff, we were at 8.5.
Yep.
And so, and then if you're working on investments and commercials, you can always look to be 1 or 2%, even higher than that. So as things are coming down, people are transacting. Like Jeff says, it's not enough product out there in regards to property. Interest rates are coming down, but you still have a high demand for properties. So at the end of the day, what's happening is we don't have as much inventory as needed. In Charlotte especially, there's a lot of building going on, new construction. People are building that way because that's where the inventory is going to come from.
Right.
A lot of new construction. And that's happening in a lot of different places. So I would say the energy is new. It's being invigorated at the top of the year because we're seeing these interest rates adjust and come down. And at the end of the day, activity is still moving and going forward. And like Jeff said, many reasons to buy. There's still a lot of investment properties out there. Properties are holding value. It's just still a great time to get in, regardless of where the interest rates were. That's how Jeff and I always talk about is if there's value in there, you should get in at some point because we know it's not a long-term strategy, it's a short-term. But as interest rates are coming down, it's a perfect segue. The individuals that listen to us and you that are listening to us on the radio that decided to take our advice and get into the market now, even if you were in on commercial or the traditional rates at 8, 9, 10, guess what now? 6.93. It's a great trend, is showing that the short-term strategy to refinance is available and you can take advantage of it still in this market.
Well, I also think that not only are they great when the rates come down, there's an opportunity to refi and save some money. But there's also, if you use the same people, if you have a trusted person that you use, they probably do it for a lot cheaper, especially if you're going to refi right away. That's probably in your long-term strategy when you're buying at a higher rate anyway. So I think these relationships you build with customers, that trust level has to be there so that there is this ability to be able to move quickly and not have to pay every time through the teeth.
Well, Jeff just said something so interesting. It's what we do. We create relationships, generational relationships, for financing and providing mortgages for grandparents and parents and
Right.
children.
That's right.
The idea is that you would like to be that person, just like you have a family doctor, just like you have a family lawyer, a dentist, anything else. We try to create relationships so we can be that guy. When the interest rates are low, anybody's that guy. But at the end of the day,
That's
it's
right.
when the markets are tough is when guys like Jeff and myself are there. And thousands in the industry are people that have formulated relationships, and even when the times get rough and the interest rate's high, you still have a trusted individual that will guide you in a path, in a space, and give you suggestions and give you some information so that you can make strategic decisions and know that down the line they will be able to help you. And what Jeff said also is, can do it for a lower amount because you got a relationship and they won't charge you as much. The issue that Jeff and I have, and people like us have been doing it forever, is there's people that have been to 20 other loan officers and come to you and they want to negotiate your fee before
Right.
you start, never seen them before.
Right.
That's the hard part.
Well,
That's the funny
yeah.
part.
No, I think there's a lot of attack on other people's money. I never like to reach into someone's pocket. I never want to say, hey, you know what? What are you making? I want to see it because I want some of it. There's a lot of that in our industry. You know it and I know it. There's a lot of that in a lot of different industries. It's just not something that is normalized just because it's done. And in the scope of any business relationship, everybody's open to talking about negotiating fees. That's just part of the business. But it is not something that anybody walking in the door can go to 10 other people and get the lowest deal and get the best loan officer. It just doesn't work that way. You're going to get what you pay for, and that's, you're going to get a low price and a terrible loan officer. So you're stuck in a contract. You don't have a loan. You got 3 days to close. Now what do? Your security deposit's at risk, and you got no loan. That happens.
And even still, we always find a way. One thing I will say about Mr. Barton, who has always been a fearless leader, and he always says, at the end of the day, we still try to do the best we can, even for that individual.
Absolutely.
For sure.
That's the name of the. That's when you're in that kind of business, you're a fiduciary. You're trying to do the best for your client always. That's at the heart of what the business for us is about, is to do that. Let's get into programs. Got a couple minutes left. Tell me, where are the dollars being spent? Where is the borrowing taking place? Is it still in the non-QM space? Are we seeing any drift back to the 30-year because rates have come down? What's happening?
Yes, all those things that Jeff said, real and true. A lot of people looking back at traditional loans. A lot of people recently taking advantage of a lot of down payment assistance programs that are out there to get help with assistance for down payments. One thing you have to understand about the industry and the market is that there's funds out there for individuals who have a proven track record of paying their leases and paying their rent.
Yeah, right.
Those are individuals that are hard workers that can show on paper that they have a consistent job, have consistent income, have a consistent employment history, and have a history that is going to show that they'll be employed for the future. Those individuals don't have a problem with their monthly payments. The issues that they have is the down payments, is gathering enough money, because life happens every day,
Yep.
to load up, to stock up, to have 3%, 5%, 10% down. Those individuals, there's hope for you as well out there, because there are down payment assistance programs that will loan you or grant you that down payment, that lump sum that you don't have, because your proven track record and history of making your monthly payments on time will allow you an opportunity to get involved with the down payment assistance program and qualify. Also, like Jeff said, non-QM loans that are non-qualified mortgages, that will allow you to utilize a different financial structure than the normal traditional structure of a traditional or government loan, which requires 60 days bank statements, 30 days paycheck stubs, and 2 years tax returns. Now you can utilize your bank statements, 12 months of your bank statements, take your average, or a CPA if you have a CPA letter, if you're an entrepreneur, someone that can justify and verify that your income is what it is, and we'll stand for you. Those are different alternative document kind of structures that will allow individuals to qualify if they don't have the traditional structure of a loan, financing for a loan. Great programs out there. Now the interest rates have come down. I've seen some non-QM programs bring their rates down to 8, down into the 7s. Great programs, still competitive, that can compete with the traditional market. Individuals should be, if your loan officer is in the game and on it every day, these are questions you can ask to them about different programs that can help you qualify if you just can't cut it with the traditional financial structure.
Charles, I'm sorry, we are up against it. Could you let people know how to get in touch with you in the new year? This is great.
I most certainly will.
Great.
I am still at that good old Las Vegas, 702-328-5191. That's 702-328-5191. Or you can email me at cgiscombe@usfwholesale.net. That's cgiscombe@usfwholesale.net.
Excellent. Charles, thank you very much for coming on. I want to have a great 2024, and I anticipate the show will be there as well. Thanks very much for coming on again.
Always a pleasure to have me, especially in the new year. Thank you so much.
Thank you, too. I'm Jeff Barton, your voice in the mortgage industry. That was Charles Giscombe from USF. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week as we bring to you the best and brightest minds in the business to talk about the mortgages, the products, the market conditions, what's a good time, what's not a good time, how to process what mortgage loan officers are telling you, whether you're getting ripped, whether you're not getting ripped off. All these things are important in our business. The most important thing to do is to build relationships with people you trust and who know what they're doing. This next guest of ours is such a person, been with us. We've talked to Eric from Angel Oak for years. He's Vice President of Business Development for Angel Oak Mortgage Solutions. He joins us now. Eric, how are you?
I'm doing well, Jeff. Happy New Year's to you.
And Happy New Year's to you, too. I really appreciate you coming on the show and talking a little bit about what's going on over at Angel Oak as well as market conditions early in 2024 when people are anxious to see where the market's going.
Well, yeah, we at Angel Oak, we adapt to the current market conditions.
Okay.
Being nobody's going to touch that first mortgage rate in the threes, some even at 2.75. That is a generational rate that we will not see for another generation.
Right.
The perfect storm with COVID and the Fed trying to stimulate the economy is what drove us there. But now that is a thing of the past. There is no rate and term refinances anymore. That is just a thing of the past. So what's left? Well, what's left is private money for non-owner-occupied property. But when it's an owner-occupied property, we have to deal with the ATR regulation, meaning the ability to repay. You see, since the financial meltdown, the Frank-Dodd Act imposed the ATR regulation, meaning that every borrower has a 3-year statute of limitation to sue their lender for their inability to repay their primary mortgage. Is this not a great country or what? So with that said, now we have a lot of folks out there. There are well over 20 million Americans that are self-employed full-time, 56 million Americans that identify as self-employed, meaning they probably have a side hustle, they're 1099 or something. And you have this huge demographic out there that's taking advantage of our 75,000-page tax code with the IRS, and they're writing everything off. But goodness, now it's time to, do a mortgage loan, maybe get a HELOC and pull some of their equity off the table, or even to go buy a house, and they just simply don't show enough income. That's why we have these bank statement loans. We have a bank statement second that does not touch the first. Listen, we have this perfect storm.
Right.
We have an all-time record high in consumer debt, car loans, credit card loans, student loans, all-time record high. Along with that, we have an all-time record high in home equity.
Yep.
But then we have this all-time record low first mortgage interest rate. So look at all the folks that have a ton of equity in their property. They certainly don't want to touch that first mortgage rate. So what do? They can opt to get a second mortgage and pull some equity off the table to pay down bills, because these rates are, let's just say, in the 7s and 8s. Credit card bills are at the 18 to
32. I've seen some.
29.95%.
Yeah, they're really out of control.
Yes, sir.
So when describing these types of loans, now I love the second loan product that you're talking about because, as you said, tapping into some of this equity to help pay off the debt, either your credit card debt or your student loan debt or whatever it is that you have. A lot of people get in, like you said, 3% or less or even a little bit more. But those, nobody's going to trade that in unless you absolutely have to do that. So being creative with these seconds is a good way to go. How do people qualify for them?
That's right. These programs are designed to literally cater to people in this current market.
Right. And
they're very easy loans to do. We just document the ability to repay based on what they're depositing in their personal or in their business checking account. It's really not complicated.
Right. Okay. And I don't know if you heard me, or I'm having you go in and out a little bit, but the qualification process for these types of loans, is it very similar to the regular 30-year fixed loan?
They are, except instead of tax returns, we just simply get bank statements to see what kind of cash flow. We offer these borrowers that we will count up to 85% of what they deposit into their personal or in their business bank account. Let's say if it's a realtor. Well, a realtor has very low overhead. The broker of record pays the realtor into their personal checking account, but yet they write everything off. Well, we'll use 85% of what they deposit into their personal checking account as their income. The debt-to-income ratio can be as high as 50% front end and 50% back end, which is very aggressive.
Yeah, no, I like that loan. I like it a lot. The money that's available out there for these types of loans, I don't know. We had a guest on earlier talking about down payment assistance programs, and of course they're all waiting for either the money to run out early in the year, or there's a budget on that they only let out a certain amount each quarter. The money available for these seconds, you guys are well heeled, and so it should be available the entire year?
Oh, heck yeah. We're not running out of money. We'll go to 85% combined loan to value cash out on these.
Okay.
On a regular bank statement loan, we go to 90% a loan to value, and there's never any mortgage insurance and never any prepay on these seconds. Even if it's on an investment property, there's no prepay.
Do you see purchase loans at all in your line of work at this point for Angel Oak? I mean, are there people out there going to you for this first mortgage purchase at all?
Jeff, you're asking if they're using the second as an 80-20 purchase or something?
No, but that's an interesting question too. No, I was just seeing, changing gears a little bit, if in fact you saw purchase deals come across your desk or your company's portfolio of loans that you're doing this year, are they coming to you because the process may be easier than going to a standard lender?
Interesting. No, if they can go to a standard lender, get it conforming, a Fannie or a Freddie or a VA or FHA, those rates are subsidized by you and I and all the listeners as taxpayers. We subsidize those rates. That's a government program. This is all private capital. So if they fit into a government program, it's normally a point to a point and a half lower in rate than these loans.
Okay, so and then to follow up with your particular observation, are these seconds used as purchase loans after the first? Meaning
That's
like a piggyback
question.
or
We have
something?
people that are taking seconds on investment properties and putting that money towards a bigger down payment on a primary resident, because I'm telling you what, there's a lot of people doing very well out there in this economy, and they're buying luxury real estate and there's no slowing down with them. They're really not that rate sensitive. All they care about is, these type of people are cash flowing very well, and they don't blink at a $30,000 a month mortgage payment.
Wow. Good for them. I mean, there should be some of those people out there. It's just not me.
Yeah, not me either. So, but these loans are for the even the sole proprietor who's never even so much as gotten an LLC, just started a business, and 10 years later, their business is doing really well. They're still a sole proprietor. They don't even have a business checking account, and now they're looking to buy a house. We cater to them.
Well, that's a terrific market. I'm sure this last year was probably a transition year because we had such high rates, but we're seeing the rates in general come down, and I think they will be coming down a little bit more slowly, but towards the end of the year we may see even the low sixes. That obviously is going to help everybody in the business. Where do you see rates going?
We believe in the same thing, Jeff.
Okay.
That's exactly it. We're heading into a little bit of a recession. Plus, it's an election year, so the current administration is absolutely going to play with the Fed interest rate, lower it, and saying, "Hey, everybody, look at how well we're doing," and hopefully try to buy votes that way. And with that said, what that's going to do is supply and demand is going to kick in.
Yep.
More people are going to be able to qualify to buy a house, which is going to drive up the price of real estate.
Yeah, unless we build 1.5 million homes tomorrow, this supply side part of the equation is never going to get fixed. I wish I had the answer to it beyond that, but that's the way it's been for the last 10 years. So I don't know where we stand after that.
Yeah, we just need to cut all the red tape that is required to build residential housing.
Yep,
and,
I agreed.
And let home builders literally build enough inventory to literally satisfy the demand for our current country. We are literally 5 to 6 million homes shy of being at break even right now.
I agree. Listen, we're at the end of our time. I apologize. I wish we had more time, and I'd like to get you back on later in the year, but thanks very much for coming on the show.
Thank you very much for informing everybody, Jeff, and you're the best.
Oh, thank you, Eric Morganson from Angel Oak Mortgage. Appreciate you very much. And if you could let people know how they might be able to get in touch with you, that'd be awesome, if you could answer some questions for them.
Certainly. My phone number is 949-554-5000. Once again, 949-554-5000. Give me a call. I'll help you with a scenario. Love to put people into homes and love to help people access some of their equity.
Thank you very much, Eric. Thanks for coming on the show.
Thank you, Jeff.
Thank you. That's Eric Morganson from Angel Oak Mortgage. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week. Our show is broadcast at KCAA in the Inland Empire, San Bernardino, Riverside counties. We are on the air Saturday and Sunday. You can hear us when you're driving around, you're going to the store, you're going to the hardware store, maybe coming back from some church or religious thing on the weekends. Tune us in. We try to bring to you the information that you're really going to need and be able to access and use, especially with mortgage interest rates coming back down. There may be some more rate reductions. All of these things are of interest to you, and you really need to do it. However, we're also on a bunch of podcasts, and these podcasts are available where, Darryl?
Oh, a number of places. Apple Podcasts, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, Podclips.io, and, of course, themortgagevoice.com.
Excellent. Podclips.io. I'm going to give them a plug again in 24. Great place to centralize your podcasting needs and uses. There are a bunch of different categories and great people on there, whether you're talking about financial stuff, which is I'm talking about, whether it's health, whether it's lifestyle, whether it's contract. I mean, anybody who's ever been in a real estate contract knows that there's a clause in there that says if you get into a dispute, what do? Well, that's what these couple of guys talk about, what happens in those disputes and who runs it. It's called ADR alternative dispute resolution, and it's pretty interesting. It's a good listen. Podclips.io. Go there. Central podcasting needs. Okay, I am Jeff Barton, and this is The Mortgage Voice. Thanks for tuning in. Talked a little bit earlier in the segment about the record number of people backing out of real estate deals, and one of the reasons, and the several reasons that I gave, were from an article I read on Yahoo, about a week ago. Found it very interesting. In a completely different place on the net. Of course, everything's on the net, and that's where I do most of my research. It was interesting to see that they talked about in this other article the costly repairs. What are the 5 costly repairs to skip making this year in 24? When we as real estate agents, and I've been a real estate broker for many, many decades, we look at the analysis, right? If you spend this amount of money and you're going to sell your house in the next 3 to 5 years, is it worth spending that money to make that improvement? Will you ever get the money out? One of the big things we always used to talk about, and I think they still do, is swimming pools. Okay, so there are several things on this list, 3 or 4 or 5 different things on the list that you really shouldn't be doing. One of the things is, as I said just prior, swimming pools. Swimming pools cost. They can cost upwards, to depending on how big and what you do. But let's say $50 grand. $50 grand, if you got a flat lot and no geological issues, you could probably put a pool in your yard, right? Is that worth doing? And is it worth doing this year in 2024? Will you get the money out that you put in? And no is the answer. So don't do it. If you need to absolutely have a pool, join a pool. It's cheaper, and there's plenty of them, especially around Southern California. You can find a community pool, a Y pool. There's all kinds of things. But the swimming pool, no, that's out. Okay, there's another thing. All right, now, this is going to sound silly. Breakfast nook. Do not build a breakfast nook. Now, I had to look nook up. Now, I came across nookie. Now, that's a different kind of nook. But nook, Daryl, do you know what a nook is?
Yeah, it's just a sort of a corner of the world. It's like a booth at the coffee shop.
Okay.
You have at your house. Yeah.
Right. Okay. So if you're thinking of building a booth, a little area, it's not worth it. Just don't do it. And the cost of these things make it prohibitive. They just say, look, if you're looking to maximize the amount of money to get out of your house or things that just aren't worth it, that's one of them. Okay, here's one that I argue with this one because I always think more square footage in your house is going to make your house more valuable. Really depends, right? So additional square footage. The example in the article was 100 square feet more. Like the average house in America is 2,480 feet. So if you added an extra 100 feet, meaning it would be 2,580 feet, is it worth it? Well, the cost analysis, what it would cost you anywhere from $8,000 to $20,000. Now that sounds cheap to me, but I live in a different world. I live over here next to the ocean. Maybe those people that live next to the mountains would think $8,000 to $20,000 is a huge amount of money, and they wouldn't do it. The article says don't do it, and they say don't do it because it's just not worth it. You're not going to increase the value of your house, although you may increase the amount. And this is the thing they don't quantify is the pleasure of living there. Whether you have a swimming pool or whether you have the more square footage in your house or whether you have the breakfast nook. All of these things may make your life more fun, more pleasurable. You get to have more pride in your house. Maybe that's worth the money that you're going to spend into it. But these people in the article say, nope, don't do it. Garage Bay Edition. You got a 2-car garage. You just bought that new Maserati because you just got that raise at work. You need a place to put it. So you build an extra bay in your garage. They say, don't do it. It's silly. It's stupid. You will never recoup the amount of money it costs you to do that. $5,000 to $10,000 to build, to buy, to put the slab down, not to mention the time and effort it costs to get this through permitting. Or you can do the old, I'm going to build it and then I will get the permitting later. And it's easier to pay the fine than to get the permit. No, I understand the mentality. I've seen it done before. I just think, according to this article, they say don't do it. And the last one, of course, is the built-in entertainment system. Now, the entertainment system per se, what is that nowadays? Daryl, if you had to guess, what would you put in something that called an entertainment system?
Well, it's something where the speakers are, hidden in the walls, and you don't have wires running around, and you've got, lots of speakers, and the room rumbles when Morgan Freeman talks.
Okay, so it's TV, it's video,
Big bass.
Is it computer also? Is it smart TVs?
It can be all those things,
Okay,
especially smart TV.
And I envision this huge wall thing.
Yeah.
That everything's sort of like there, like, you're on the deck of the Star Trek or something.
Yeah, they've got a thing on cable now where you can watch 6 different channels all at the same time.
Okay, so
like
it's kind of like that. Well,
the big wall.
They say don't do it. Just it's not worth it. It's not. Now I don't know whether the components aren't worth it, whether the actual wall unit is what they're talking about, but I've never liked it. I like stuff all over the place because I don't need neat and clean. What I need is access. If I need to change something, move something, you have to get to these wires. Otherwise it just stays there. I have one piece of equipment at my house we haven't moved in 20 years because I can't get to the source of where the wires are coming from, wherever they're coming from, and quite frankly I don't know where they're coming from, and that's one of the issues of me coming back home is to figure out where all this stuff belongs. Anyway,
the other thing is like home theater, right, where they put in actual seats and stuff. I don't have
I don't know. No, I don't like that at all.
I don't have that many friends.
I mean, geez, come on, really? You really need a movie theater in your house? You got way too much money. You know what I mean? That is just... Now, I like a lot of the things that they can do with architecture and how homes look, but the home movie theater thing, first of all, I'd rather be on the couch than in one of these movie theater seats. But,
Absolutely.
It's just me. Anyway, that's what they say. Now, for the last minute 40, I'm just going to get into a little, a little pontificating, a little preaching here. There are a couple things that came up at the end of the year that are of issue going forward. We talk a lot about inflation the last year and how inflation is coming down, and that's a good thing. My friend Mike Roach, who I told you I was going to talk a little bit about, he talked about printing money and how money's worth a lot less today than it was before the pandemic, and I totally agree. He said 17%. I don't know what the actual percentage is, but everybody out there knows exactly what I'm talking about. It's why things cost more now and they haven't come back down is because the money's worth less. So you got to make more to buy the same stuff, whether those prices came down or not. But I have always, in this setting, said, you know what, there are so many industries that just jack the price because they could. Because the basis for all of this is I got to get more while paying less. And however that's done, whether it's the government doing it, whether it's a company doing it, or whether it's your service that you're just charging more than you should charge. I have a person that is trying to help another individual as a house person, i.e. come in, care for a person. They have doubled and tripled their prices during the last 2 or 3 years. Now, granted, these people, they deserve whatever they can get. But you don't need to do that in order to, make a living. Let's get to the public sector of all this. Gas prices. Average price right now, $3.09. Lowest it's been in a year in 28 different states. However, they say price is going to go up to $3.49 per gallon. Never understood why gas prices are what they are. If anybody can actually tell me why prices go up when there's a summer blend, whatever the heck that means. Okay, and the other one is there's a French retail giant, Carrefour, Carrefour, and they have refused to stock and sell Pepsi and 7-Up. Why? Because Pepsi and 7-Up decided to raise their prices way beyond what this particular company thinks they should. So they're not going to sell their product. That's good for them. I don't know what their grocery store chains are, but normally in the U.S., 3% is what the margins are at the grocery store. They don't set the prices. What they do is they pass the prices through, tack on their 3%, and that's what most grocers do here in the States. But these Pepsi and 7-Up people are like so many people in the retail business. They just jacked it because they could. They didn't have to, but they did. And I read an article earlier that it was really a time where a lot of prices currently are coming down in the marketplace, especially with electronics. Let's hope we see the reduction in prices across the board. I'm Jeff Barton, your voice in the mortgage industry. Thanks for tuning in. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
Miss something today, yesterday, last week? Check out our podcasts at www.kcaaradio.com. We